Hey everyone, Ryan Bolton here. I am the Mortgage Nerd. I work with Patriot Home Mortgage in St. George, Utah, which is in the southern part of the state. We're just a little bit north of Las Vegas, kind of on the border of Utah, Arizona, and Nevada. And just love this area. Moved here in 2005 and absolutely love the southern Utah area. I'm licensed in Utah and Nevada, so I'd love an opportunity to work with you in those states. But I also have other loan officers here at Patriot that are licensed in other states. So if you need any help, let me reach out. I can direct you to the right person. Maybe I can help you even just answer questions and just kind of give you an idea where the next place to go or advice I can give you. I do a lot of advice when it comes to just general real estate purchasing or even credit. So it's just good to kind of know how some of this stuff works. And I love an opportunity to work with you. So check out my website at ryanbolton.com. But today's video, we're going to do a little Q&A. Found some questions. People have been commenting on some of my videos. So if you have a question or a comment or concern or something like that that has anything to do with real estate financing, mortgage loans, things like that. Love your participation in this whole thing, and just put comments down below, and I'll get to them in a future video. So let's go ahead and get to the first question here. And I run across this question in a couple different forms, and it basically comes across mostly like this: can a local mortgage company or a local mortgage company be better interest rates than these online mortgage companies? And here's what I'll often say in that situation is we all get the money from the same sources. The money that they're getting is not cheaper than the money I'm getting. Now, maybe a local presence might have more overhead. They may have more things that they have to cover, but some of these online companies too have these big call centers in California and rented out entire office spaces that cost them a whole bunch of money per month. But a lot of times they're just kind of dialing for dollars on these online type things, and they have been able to kind of reduce some of their cost of originating the loan. But I found that the cost to originate a loan is basically the same no matter who's really doing it. And we're all getting the money from the same sources. We're all following the same guidelines. You will see some what's called overlays. You'll see some lenders that maybe take a Fannie or Freddie guideline or an FHA guideline and maybe add a little something extra to it because as they service loans, maybe they're seeing in certain regions that they want a little bit more for their shareholders, or they keep running across this issue in a certain part of the country. And so they kind of add this overlay to deal with maybe an increase in foreclosures or issues, or they just keep running across the question. Their underwriter keeps saying, well, we keep having to deal with this issue, especially in this region. So we need to come up with a guideline to deal with that. So it's not like an exception every single time the file comes in. So, but we're all really getting the money from the same sources. We're following pretty much the same guidelines. Now, loan officers may be compensated differently. They may be on a different comp structure, and that can affect it. But when it comes to interest rates, I think local's better. I think servicing is better. I think there's a lot of things that happen when you can meet face to face if you need to, when they know your local market, they know the title companies, insurance companies, appraisers. There's just a lot of things that can be better when you're working with kind of boots on the ground. And that's what I found why I target most of my marketing more locally than trying to do loans throughout every state. So I try to kind of do in the areas I live, work, and play. And that's why I focus most of my effort in Utah and Nevada. But it is something where it's still good to shop. It's still good to check references. It's still good to kind of get a couple different loan estimates, but you're not going to see a huge difference in interest rates. You're really not. Fees may be different a little bit. Maybe some fees, some lenders maybe charge $9.95 and a bunch of other little junk fees, or maybe some charge more for credit reports based on what they have to pay for. Maybe appraisals can be a little bit different, but it really isn't a huge difference. It's really who you're working with, the loan officer that's in the mud with you going through and figuring out how to get your loan done. That's who you really need to shop more so than I think really online lenders versus local. We're all getting the money from the same sources. So there really isn't going to be a huge difference when it comes to that. All right, let's go to a couple other questions here. Let's see. Can I use my wife's credit and my income to buy a house? I run across this a ton of times where the wife will have a higher credit score but no income. The husband has a lower credit score but has all the income. Short answer is no. Whoever's on the credit or whoever's on the application is one equally responsible to pay the debt. If they have to use your income to qualify, you need to be on the loan. So if your score is lower, it'll go off of your credit profile. So maybe there's some things you can do to fix your credit, or maybe there's some things we can do to kind of get your credit score higher. But I often see a lot of times where the wife's credit scores are higher. Now, people might say, well, that's because there's a bias or something because they know that it's a woman or what their age is or something like that. It really has very little to do with that. It's simply an algorithm that's taking into consideration the credit history. And usually the men are more the primary borrower. They usually have more inquiries on their credit. They usually utilize their credit more often. So it's a different score. It's just a different score, but it's not, there's nothing in the system that factors in the date of birth or factors in the gender of the person that's on the application. That's not part of what we put in when we do a credit application. It's social, date of birth, name, that type of thing. So now, is there something embedded in the algorithm? Maybe, but I don't think so. The Fair Credit Reporting Act would prevent that. And really, it doesn't need to have that built in. It doesn't need to have that built into the algorithm. So the short answer is no. If you use your income, you've got to be on the loan. And if your credit score is lower, then the loan's going to go off your lower credit score and vice versa. Now, you can add her to the loan for credit or income or assets, but you can't remove your credit but use your income. So short answer to that, no, you can't use your wife's credit and your income. You both have to be on the loan if you both are on it to qualify. Now, maybe you don't need your wife on the loan at all because you make all the income and she doesn't need to be on there, but you still want to add her to the title report of the property. So there's some things we can talk about, kind of get in the weeds there if you're running into that situation, but want to answer that question as quickly as possible. We try to keep these videos about 20 minutes, so we just got started here, only 6 minutes into it. But let's see how many other answers we can do. All right, let's see. Do mortgage lenders give the lowest rates to people with high down payments? Generally, yes. That's one of the factors that determines the interest rate. But you can have a higher down payment, still have a bad credit score, bad debt ratio, and you still might see a slightly higher rate. But one of the biggest ways to reduce your risk, which is what affects your interest rate the most, is having more skin in the game, more down payment. Because the more money you have down, if the loan does go bad, the more likely the lender is going to get their money back and the less likely you're going to just walk away because you've got some skin in the game, you've got some down payment, you've got some equity in the home. So down payment is one of the biggest factors to determine interest rate, but it's not the only one. So it is something where if you combination of down payment, good debt ratio, and credit score, that's when you're going to see the best rates kick in. Typically anything over about 30% down is usually the top tier. I've seen some where if you put 35%, you get a little better bump, but that's kind of where you start seeing rates. But once you get past about 35% down, there's not a huge difference in interest rate other than the other factors like debt ratio and credit score. But it is something, absolutely. The more money you put down, the lower your risk, which lowers your interest rate. And also to say on that as well, I've seen times where people want to put the 20% down, but we've actually run the numbers and said you're better off to put 10% down, have that higher payment, but take the 10% and get rid of all the other debts that have a higher interest rate or higher cash flow or just more money going towards the other debts. Like the other day, I had a client had about $40,000 worth of debt, but it was like $1,300 a month for that $40,000. So I said, why don't you take, instead of as much of a money down, let's get rid of all the other debts. Now you can afford a little bit more home because now you kind of freed up your budget a little bit and you're getting rid of all the other debts. All she had left over was like a car payment in the house. That was it. And it still ended up being cheaper than the first home she was looking at and that she didn't really like. That was all that she could kind of afford. So as I started looking at it, I'm like, wait a minute, you've got all this other debt. Let's get rid of that. Let's free up this cash flow and get you in a home. Now, people will say, well, why would I pay off a 5-year loan and put it onto a 30-year fixed? It has a lot more to do with the cash flow and where that money is better served and where else it can go. In her situation, she got the better house, the cheaper overall debt, still had money left over, and was less than she was going to pay by keeping her debt and buying the cheaper house. It was great running those numbers. If you're not sitting down and kind of figuring out those numbers, you might be leaving money on the table. So part of my job is to review everything that they're trying to do. Now, I would say maybe 50-60% of the time it just is the original loan. They come in the door and we don't change anything. But a lot of times we kind of review it and say, okay, have you thought of this? And they didn't even think about it. And we start running the numbers like, wow, this makes a lot more sense to put less money down than it is to try to, even if the rate is slightly higher and there's mortgage insurance added on there, if you look at where else that money is better served, it can actually make more sense in your overall financial picture or just get you into a better loan to begin with. So that's kind of a little soapbox there when it comes to putting the extra money down and what makes the most sense. All right, let's go here. Let's see. Let's see. What is a reason that someone can be denied for a mortgage? So this pops up a lot, or this form of this question pops up a lot, is things that you need to be aware of when trying to apply for a loan. And there's really going to be kind of four categories we're looking at. And if you don't meet those guidelines, you don't get the loan. So a lot of it will be income. If you don't make enough income to qualify for the debt or the ability to repay the loan, then you're going to get denied for the loan. Credit scores are probably one of the biggest things. So I'd say the two biggest is going to be either credit or income will be the two biggest reasons why people actually get denied for a mortgage loan, because they just have a payment more than their debts, or their scores just don't qualify, or something along those lines. So that's probably the biggest reason why people would be denied. To give you an idea on income, we typically take your gross income. If you're self employed, it's after your expenses. So it's your adjusted gross income. We can add back in depreciation. We can get rid of maybe car payments. Let's say the business is paying the car payment. So there's ways we can kind of review your income and make sure we're getting everything out of it. But generally, they're going to go off your taxable income on self employed, where W 2 is going to go off your W 2 income. They typically like to take a 24-month, a 2-year average of that job. There is ways to be able to say, well, 6 months ago they got a raise, so we can go off that number. So there's all kinds of ways we try to calculate the income. But the more conservative we can calculate it, the more likely it's going to go through on the approval. If we have to get exception after exception or kind of stretch the income to the very limits, then that's where it gets harder and harder for an underwriter to sign off on the loan. But generally, they want to be around 45% of your gross monthly income, however they calculate that income, self-employed. And so there's different ways they calculate it. But generally, you want to be right around that 45%. Now, I've seen it get approved clear up to 55%, but generally, if you're under that 45, and how that works is you add up all your existing debts, so cars, visas, student loans, whatever debts that you have, other mortgages, whatever debts you have, plus the new mortgage needs to be under that 45% number. Anything above that has to have compensating factors, have to have more residual, better credit scores, more money down to kind of offset the risk of a higher debt ratio. And even some mortgage insurance companies have bigger hits if you get over that 45% mark. So it is something where that's kind of the target you want to be at. So if you're looking at your income and kind of saying, okay, we make X amount, times it by 0.5% or 0.45. So that way you get kind of that number, and all the debts need to fall under that number. That doesn't count insurances, cell phones, utilities, things like that. Just anything that's going to be kind of on credit, child support, separate maintenance, alimony, that type of stuff will count. Mortgages, HOAs, even free and clear properties, I'll have to count like taxes and insurance on that property. So part of my job is to go through there and making sure that we are calculating all the debts, getting as much income as we can, making sure we're pre-approving you for the loan amount you'll actually get approved for. And that's just part of the job. It's part of kind of figuring out what you qualify for. All right, we got 12 minutes so far. I like to try to keep these right about 20 minutes. So let's see how many more we can answer in that time. But again, if you have any questions, comments, concerns, uh, anything, just post them in the comments. I'll get to them in a future video, or I'll work it out with you, or reach out to me by going to my website. Give me a call. I can answer specific questions, maybe direct you to the right person, or see if I can help you, especially in the states of Utah and Nevada. That's where I'm licensed. All right, let's see what else we've got here. Boy, here's this question. I tell you what, I don't think there's been a time where I've scrolled through a mortgage forum and haven't run across this issue. Can I get a mortgage with bad credit? So I think every video, if you go to all my Q&As, it's probably in all of them. So I don't know if I should keep just answering, but it pops up every single time. And my answer always is, yes, you can get a mortgage with bad credit. There's people willing to loan you money on just about anything. Look at the title loans, payday loans. There's people that will loan you money if the rates offsets your credit. But I always say, why is the credit bad? What can we do to get your credit back on track? Spend some time working on that first so you get a better loan. And most mortgages, especially if you're just kind of starting out, if you can get even to a 620 credit score, you'll have loan programs that start opening up. If you can get to 660, kind of the next wave of tiers, 680, they're kind of on these 20-point tiers. If we can kind of work with you to get you into that 620s, which really isn't crazy hard if you start working on it and know how to do it, then you won't need a bad credit mortgage loan. You can get more of a traditional or an FHA or something that's a lot more closer to the interest rate that you'll actually want to have. So it is something where I always preach this. Let's work on the credit first. Let's not worry about just getting any loan that'll work or any loan that'll fit your credit. Let's work on the credit first. Let's see if we can get that score up a little bit, get a little education, maybe work on the budget a little bit, maybe work on paying off some stuff. You just put your head in the sand and didn't worry about some sort of collection years ago. Let's fix it. Let's try to get it fixed, build up some positive, give it 90 days. There's amazing amount what I've been able to do in 90 days for people to get them to the next tier. And it's well worth the effort and a little bit of patience to do it instead of just jumping into any loan you can. The other thing I will say is if you've got bad credit, you got to offset the credit with down payment. And usually you have to put a lot more money down and you're still getting a worse interest rate. So work on your credit first. That's the best thing you can do. Here's a good one. My partner passed away and I was listed on the deed, though through survivorship. I am not on the mortgage at all. The house is deeded to me. When I sell the house, do I have to pay off the mortgage? Yes. The mortgage is tied to that collateral, tied to that property. So just because the person that was on the loan passed away, the collateral is still the home. So it doesn't mean the debt just kind of goes with them. So when you sell the property, that lien needs to be released off the property. So I've seen a form of this question happen a lot to where do I have to pay the mortgage if I got deeded the property and they went away or they got divorced or they passed away or disappeared, whatever it is. You realize that the mortgage company is loaning the money not just to the person, they're loaning it to the person and the house as collateral. So that's why you get better rates in 30-year terms. And some of these things is because they know that you can't just run away. You can't just disappear. The house is going to stay there. So in this case, yes, if you're in a situation where maybe you're the kids and the parents have passed away, or something has happened where the original debtor has passed away or left or divorced or something, it's still tied to that home. So once you sell it, that'll be the first thing that gets paid off, on top of any maybe judgments or charge offs or taxes or anything else that could be leaned against that property. But the mortgage doesn't go away if the person passes away, like she's asking in this situation. All right, we got about 60 minutes. Let's see if we can get a few more here in the 20-minute time frame I try to keep these videos. Let's see. What happens if someone owns two houses, one with a reverse mortgage and one without? So the reverse mortgage needs to be the primary residence. So if you're not using it as a primary residence, then that note can be called due. But you can own multiple properties. You can even have other mortgages against other properties and still have a reverse mortgage. But the occupancy is the crucial part of a reverse mortgage. Now, I know they have some criteria of how long you can be out of the home. So maybe use the reverse mortgage for 8 months of the year and the other 4 do, I know they'll go around with RVs or they'll have a second home in the warmer months or the colder months or whatever it might be. So there is some provisions for there, but it really has to be your primary residence or the reverse mortgage can be called due. But you can have as many houses as you want, free and clear or mortgages or whatever they are. It's just the occupancy is the main thing you have to be worried about when it comes to reverse mortgages. Okay, if my mortgage holder is my mortgage holder the best source of a home equity loan if I have a sub 3% first mortgage and a healthy chunk of equity? Not necessarily, because some first mortgage companies don't do lines of credit. In fact, I would say a lot of them don't have a home equity line of credit option. This is where a local bank or credit union that's doing kind of smaller loans will typically do a home equity line of credit. And I tell you what, these have kicked up like crazy because people have 2 and 3 and 4% on their first, but they have all this equity that from 5 years and 6 years of appreciation. And they're like, hey, I want to get access to that money to pay off other debts or home improvements or anything else that they want to use that money for, or buying other properties. I've seen buy investment properties or second homes or cabins or stuff like that with all this equity that they have. That's where a home equity loan will give you a better option. So we offer those as well. So we do have home equity lines of credit that are fixed rate or some that are adjustable, kind of depending on what you're going to use that line of credit for. And usually you'll find better sources that aren't your first mortgage. And also I would say this, anybody watching this video, your mortgage most likely got sold to a servicer or transferred to a servicer. So it's not even the original company that did your loan that now you make your payments to. Very common for these loans to get sent to servicers, where servicers really don't loan new money. They might offer refinances within their portfolio, but a lot of times they don't do second mortgages or lines of credit. So if you have any questions with that, we offer lines of credit. If you'd like to see what your options are, costs nothing to find out. We don't have to pull your credit. We can just kind of do a quick review for you, show you what your available terms are on a line of credit. And then you can use that to compare with your bank or your credit union or whoever else you do your typical banking with. But I'd say day-to-day checking account type banks are the ones that offer more of the lines of credit that this question is asking for. Let's see. Ooh, I think we can squeeze maybe one more in here, depending on how soapboxy we get. So it depends on the question, I guess. Let's see. Is it possible to obtain an unsecured loan if you have a mortgage on your house? Yes. So let me reread that question. Is it possible to obtain an unsecured loan if you have a mortgage on your home? Yes, an unsecured loan is just a signature loan. It might depend on your debt ratio still. The underwriter, the person doing the loan, is still going to check your credit and check your ability to pay the loan back. But just getting some sort of unsecured loan is just like a Visa is really an unsecured loan. So it just depends on what type of loan you're trying to get. Now, if you're trying to get a loan against your home, it's always secured. A mortgage, a home loan, a home equity line of credit is using the home as part of the risk and part of the collateral to give you better rates and terms. So you're not going to get an unsecured home, or excuse me, an unsecured loan on a car or a mortgage. That is the collateral. That's part of why they're doing the loan. Most unsecured loans are just like signature loans where your credit's good enough, your risk is good enough, your income's good enough, we'll give you that loan. But it's always going to be higher rates than if you can secure that loan, because then they have one other thing they can take back if you don't make the payment. So no matter what, I don't think I've ever seen an unsecured loan that has a better interest rate than a car loan or mortgage loan or something like that with the same type of credit and income and assets. I mean, having something that's secured, especially a home that can't just get up and leave, is where you're going to see obviously the better rates and terms. Ooh, we're just over 20 minutes. Let's see if I can find one more quick one. We're having too much fun. Let's see. When buying or selling a home, which is more important, the location or the condition, age of the property? If those are the only two factors, location. Absolutely location. Location, location, location. That's why a home on the beach in Monterey is going to be worth more than Blackfoot, Idaho. You know what I mean? Location's going to be a big part of it. But if you're the same location, condition's going to be the next thing you're going to look at. Age, condition. And I don't even think age as much. It depends on the condition. I've seen homes that are 5 years old that were just beat. They were just a mess after 5 years. And I've seen other ones that with the quality construction and who was living in there, a couple of retirees or something like that just kind of use the home as a second home, and the thing's 10 years old, but it has like a year's worth of use. So condition and age is definitely something that's a factor, but I would say what determines value more than anything is going to start with location. Then right next to it's going to be age and condition. So I hope you found that information useful. Looks like we just hit over the 20-minute mark here. If you have any comments or suggestions for other videos or questions I can answer in other videos, you can put those in the comments or reach out to me. Check out my website at ryanbolton.com and I can get specific in your situation. Doesn't cost anything to talk with me. I give you pointers or reviews, review your credit, review your qualifications. That's what I do every single day, is help people into home financing. And I love an opportunity to work with you. I am licensed in Utah and Nevada, but I can direct you to other people that can do other states. But those are the two areas that I focus in. But I'd love a chance to work with you. So check out my website, ryanbolton.com. I am the Mortgage Nerd, and we'll see you on the next video.